The qualitative people aspect of it is also very, very important, right? Because you're at the end of the day, you're investing in teams, you're investing in people. And if you're investing in a fund, you're investing in the people that then invest in the people. And so it's a difficult decision, but I do think that there's a pretty big kind of psychological component to it as well. And the people part of it, I think, is just as important, if not more important, than kind of the stuff that's in the spreadsheets.
In this episode of Investors and Operators, I am speaking with Liz Weindruch, who is a managing director at Barings. And we're going to talk about emerging managers, fundraising. We're going to dive specifically into topics like who should keep their jobs, who should do more deals and not raise a fund yet, and who is ready to raise a fund. Some of these other topics are, how do you build momentum during a fundraise from the LP's perspective? What are some of the do's and don'ts in first meetings, fundraising decks, and a whole lot more? So who should listen to this? Independent sponsors, emerging managers, and anyone interested in raising funds. Liz, I would love to get a little bit of your background and the program at Barings.
Sure. Thank you, Jordan. And thank you to everyone who is listening. My name is Liz Weindruch. As Jordan mentioned, I'm a managing director at Barings. I sit on a team that's called the Diversified Alternative Equity Team. We are focused on, basically building customized investment programs for our clients, where we invest in private equity funds. We do equity co-investments, and we also make secondary purchases on their behalf. I would say that while we invest sort of generally across the market, our team is, effectively dedicated to the emerging manager opportunity set. And for those of you who are watching, you can see that I put that up in air quotes because the definition of emerging manager, I often say, depends on what day it is and what state you happen to sit in at that time, because all the definitions are different, right? So we think about it as funds 1, 2, and 3 with institutions of 2 billion or below. Independent sponsors, you also fit in this category because we really like to co-invest with independent sponsors and view that as a great way of getting to know your investment style and your parameters as we sort of build up towards, hopefully making a fund commitment at some point. My background, specifically about me, I've been in the private equity business since 2004. Have served in, consulting roles, but mostly my job has been that of an investor, mostly on the institutional side of things. So coming up on 8 years here at Barings, and sit on our investment committee and do a lot of our origination efforts as it relates to emerging managers, kind of the tip of the spear in the market when it comes to screening funds and also screening co-invest deal opportunities.
About how many buyout funds over the past 5+ years do you think you've committed to? And what does that look like for like a typical commitment size for like funds 1, for example?
Fund ones have probably been, I'd say the bulk of our investment activity with emerging managers, a lot of it is kind of in fund, that fund 2 phase. And a lot of that is because a lot of fund 1, a lot of groups that are out there raising a fund 1, we either think need to get a little bit more depth of track record or just need some more time and seasoning before we commit to a fund. In terms of a number, I mean, honestly, I'm going to make a best guess for you in that we're probably committing to upwards in the past 5 years?
Yeah, past few years.
Yeah, past few. I would say we probably do around, probably 5 fund 1s every year. So that's probably maybe a good number to think about. In terms of capital commitments, it's a range, but a good number to think about is kind of that $15 to $25 million number.
And about how big is the team on like the emerging manager team?
We view our team we're about 22 people. We mostly sit here in Charlotte, North Carolina. We've got a couple of folks in Los Angeles. We've got a presence in London. And everyone on the team, we say everyone's an originator and everybody kind of sources and underwrites emerging managers. And so I'd say that there are some of us that are maybe more focused on things like sourcing than others, but everyone on the team, underwrites funds and co-investments and secondaries with emerging managers.
In terms of strategies, it is not just emerging managers, but it is across all strategies. Mm-hmm.
Yeah, so we focus on buyouts, growth equity, infrastructure, and natural resources. And we are looking for emerging managers really kind of across those different kind of subsets of the industry. And I actually think there's a super interesting opportunity right now on the real asset side of the equation when it comes to, infrastructure managers as well as natural resources managers. If you think about kind of the growth within that specific segment of the market over the past 5 to 10 years, it kind of looks like what buyouts looked like maybe 10 to 15 years ago. So you've got these kind of like larger players at the top who've raised these huge, kind of double-digit billion-dollar funds, and that's created an opportunity for other managers to kind of, create, investment firms at kind of the mid-market and the lower end of the market to, kind of buy and grow assets to then kind of sell back up the value chain.
What are some of the strategies do you think are either overcrowded or just not as interesting for this general cycle?
So
Who should not be reaching out to you right now?
So look, there is a lot of talent out there that's raising capital that's focused on kind of just venture oriented strategies, right? Like seed, series A, those types of investments. That's not for us. That's too early for us. We don't do venture kind of, full stop, honestly. It's not because we don't believe they're good investors in that segment of the market. We just happen to believe that there's, kind of better risk adjusted opportunities in kind of more mature, investments. So I'd say if you're in venture capital, like I wish you the best and I'm happy to hopefully introduce you to folks that will invest in venture, but that's not for us right now.
If you have to take a wild guess, like how many in a given month new GPs do you think that you're being introduced to? Or how many like new discussions in a given month, like, okay, this is a first meeting kind of type of discussion?
I wish I had my calendar in front of me and I can tell you. I'd say once a week I'm talking to a new manager that I have never met before.
And that's on top of the ones who are in the pipeline, who you're developing the relationship, getting to know more, on top of your people who are already committed to and managing those relationships.
Exactly. And a lot, I mean, I'll tell you that like I'll get a message from someone maybe on LinkedIn that's like, hey, I got your name from so and so. I'm sitting inside GP XYZ. I'm thinking of leaving. What do I need to do to prepare myself to spin out? Message maybe it doesn't say that much, but the message will say like, hey, I heard that like, could we set up a call? And so I get a lot of those phone calls of folks who are, I think, maybe testing the market, or at least, there's a lot of folks who are really great at investing, but maybe, have enough self-awareness to know that they may not know what it takes to go out and, hire a team and, build a pitch book and go out and raise a fund. And so we get a lot of calls like that from folks who are saying like, hey, I'm thinking of spinning out. Like, what do I need to do to prepare myself to do it? As I'm thinking about hiring my team, who's that first hire? Is it my co-founder that I'm working with, or do I hire someone to be my CFO? Like, how does this whole market work? So we get a lot of calls like that. And I'd say most of the time those folks do kind of spin out and start a fund, but like it could take years. Like there's some calls where that have been going on for years where someone's like, yeah, like, I don't know, it may not be the right time. So I mean, we have those conversations all the time.
That's a good segue into the topic of what fund managers, what emerging managers should keep their job. And maybe as they go through this next cycle, secondly, who should just do more deals and hold off on raising a fund for whatever reasons, either team, track record, et cetera. And the third part of that, it's like, who is ready to raise a fund in this market? Let's kind of dive into that.
Yeah, no, and it's funny, one of my colleagues always says like no one wakes up in the morning saying I want to be an emerging manager, right? It's a tough journey, it's a tough slog, it's a tough fundraising market. I mean, it's, even before things got rough, it still took probably upwards of close to 2 years for an emerging manager to raise a fund one. I think that you could probably put a 3 handle on kind of how long it's going to take folks to get funds raised. And look, there's aberrations, right? There's groups out there who will raise a fund one and be one and done in, 6 months or so. And there's, a difference in sort of, those groups and their stories and others. And so I'd say the people who should keep their jobs and not leave and not become an emerging manager are the ones who are, not interested in wearing a lot of hats. They just want to do good deals. Like there are a lot of really good investors out there that, I've talked to that have said, it's just not for me, right? I don't want to be the CFO, the COO. I don't want to do, I don't want to have to go and hire a team and manage the firm. All I want to do is do good deals, right? And that's a great skill set, and that's something that, but if you're not willing to wear all the hats and kind of, build your organization, then it's probably not for you. Of the groups that should go out and do more deals, and I think that this is happening more and more now, is if you have a partnership that is comprised of a couple folks who don't have a solid working history together of doing deals at a prior firm, then I almost think you automatically need to do a few deals together to prove that you can work together, that you can work outside the construct of your prior organization. So some things like that. Like we like to say, I don't like to back a shotgun wedding, right? You don't necessarily know like how people are going to work together, and so I think it's pretty important for folks who haven't worked together to do some deals as an independent sponsor before they go out and before they raise a fund. Now, the number of deals, like I don't know if there's a magic number. I think that some folks would, for me, it's more than one. It's probably, 3 or 4 with hopefully some form of liquidity or a realization to then come to the market and say, hey, look, we've round tripped the deal. We've worked together. We've, kind of worked through some good times and bad, and now we're out to raise a fund.
And so those 3 or 4 deals have to be consistent with the investment strategy that they're pitching, not something in 3 different opportunistic strategies.
Right. Well, and hopefully consistent with what they've done at their prior organizations too, right? So if they have been, working at a large market PE shop, investing in, $2 billion enterprise deals, you don't want to see them go out and, start playing in the micro cap space and buying businesses with 5 million of EBITDA. So it's, the strategy at the larger end of the market does not necessarily translate down to the smaller end of the market. So from a size perspective, from a, value versus growth orientation, from a sector perspective, you want to make sure that they're kind of staying, kind of in the lanes that they were in when they were investing at their prior shop.
So let's talk about do's and don'ts. Like, let's go through the life cycle of emerging managers interacting with you from the very first message where it's an email or a LinkedIn message. Let's just start there. Like, what are the do's and don'ts of how to effectively interact with your organization?
So my job is to take every call, to respond to every email, and to give everyone that's reached out to us an opportunity to tell their story. And so I would say that first outreach, like I wouldn't have people get too, nervous about that. Just send a note and say, hey, would love to set up a time to learn more about what you're doing and tell you about what I'm doing and see if there's a potential match. I would say that typically the first thing that we ask for is a pitch book. And I talked to someone last week who said, gosh, I don't have a pitch book. And I said, well, do you have a website? And I don't have a website either. So things like that, are pretty important to have, the website less so, but having a pitch book that articulates who you are, what your strategy is, what your background is, the background of your team, that's pretty important. And so, and it's also something that, we kind of utilize kind of to go into the discussion that we have with them. I would also say that, and we do something a little bit different than I think a lot of other folks in the market, is that we will have initial screening discussions that are 30 minutes, which is not a long time to be able to kind of tell your story. And so I think a lot of groups maybe that are working with placement agents or working with others think that they have an hour to just sort of pitch and talk at somebody. What we try to do is I spend 90 seconds giving the kind of spiel on who we are, what we do, what we look for, what's important to us, and then have them tell their story. But I'm more interested in knowing the why, right? Like, why did you leave your firm? Why are you better off operating independently? And why am I better off investing with you operating independently? I like it when folks also lead with a track record, if it exists or if it doesn't, right? Not everyone has something pretty on paper, that's been, kind of memorialized and, checked off by attorneys. But a lot of folks do say, hey, I may not have formal attribution for these deals, but I have a list of CEOs that you can call. I have a list of, lenders that you can call. I have a list of prior investors that I've worked with that you can call to reference me, to kind of, really validate and my track record that I have. So it's nothing on paper, but you can validate it. And that to me is just fine. I'm happy with that. But we also want to make sure that it's not there. You haven't cherry picked from the track record too, right? So we want to make sure that it's kind of, complete and all of that. So we spend the first 30 minutes really getting to know who you are, why you came together, what is your strategy, and like, why are you different than kind of anyone else that's out there?
How much do you think people really are different within certain strategies? Like, if you just look at buyout, and I mean, like, within industrial buyouts, healthcare buyouts, consumer, how different are these stories actually? And how can people truly differentiate? Like, what is the one like, what are the stories that you're telling me back? And you're like, okay, listen, I've heard this 1,000 times. You're not really that different. Cool, you're a good manager. Fine, whatever. I'll just throw you another good tier one bucket. Like, is there actual differentiation?
I think that there is, and I think that it comes from a combination, and it's nothing sexy, right? Like it's a combination of experience within a certain deal type or a sector. And I do think that and the market's evolved a lot over the past, decade or so, but I think a lot of differentiation really comes down to, networks and sourcing and the ability to source a good deal, right? Anyone can hang up a middle market shop shingle and get on the list for all the banks and get all the books and the sims and can pay the highest price and win. I think that where you do find true differentiation is in somebody who is able to meet with a management team, connect with them immediately, either because they have a story that's very similar to, the management teams of saying like, hey, I've owned a business that did what you did, and here's how we changed it, and this is, kind of what we did to transform the business. Or a lot of general partners will bring in an operating partner who has that experience and knows the business. I think that there's a lot to be said in terms of being able to differentiate yourself in sourcing in those first few meetings with management teams. You just have to, do your homework, and there's no shortcut to experience in the space. So if I think about emerging managers that we've backed, the average amount of experience at the partner level is 2 decades. So it's, I don't think there's a shortcut for that.
So double click on the sourcing. Like, what are either the slides or the explanations of the when they have the sourcing discussion? What are the ones that like, all right, they clearly have their stuff together. What does that actually mean to you? And what are the ones you're like, all right, this is like everything else I've seen. This is not actually differentiated sourcing.
Yeah, no, I mean, look, everyone's going to show you a slide with like the funnel and the flywheel. Like those are in every deck, right? Where I think it really comes out is not necessarily in the sourcing slide, but in the stories that go along with it. And so that is where, and I think a lot of folks are very quick to and want to jump to case studies. I think some of the better pitches that I have heard are ones that talk about the theoretical, but then back it up with examples. So you can talk about sourcing all day long. You can say that, we have our database of X number of bankers, and everyone throws the word proprietary in there, which I'm throwing in quotes too, because I don't think it necessarily means a whole lot anymore.
I think like average banker slash business broker is the new proprietary.
Exactly, right? It's not a bulge bracket shop, it's like a boutique M&A shop. So, right? So it's proprietary because the banker called us first.
Regional banker is the new proprietary.
Yes. But it's it's the stories that go along with it. And I'll say a lot of emerging managers, we've had success with emerging managers in the past who have come with a differentiated story and an asset to invest in at the same time. And in many cases, those assets are, they have either owned in the past from their prior firm experience, or they are spinning out and buying that asset from their prior firm. And that tends to be a pretty differentiated situation because, they've left their firm. This asset is, not necessarily orphaned, right? But the kind of the domain expertise on the business has left the building, if you will. And then you've got these folks saying, hey, we know it. We know the nuances. We know how to price it. We know if there was a COVID bump or a COVID slump or kind of however you want to describe it these days. And we know how to, underwrite it. And they're motivated to sell it to us because they don't want to own it anymore. And so we've had, a few situations where we've been able to co-invest with an emerging manager in those situations. And that's actually ideal because you can see, it's a very differentiated situation that they're in, as opposed to, hey, like we're runners up in this auction process, or, we were participating in a process and we prevailed.
Over to the team and that kind of first meeting or beforehand, what are some of the do's and don'ts in discussing your team? What are the stories that really stick out to you are the ones like, you know what, they just absolutely crushed it, and how they just conveyed their team? And maybe the opposite are the ones you're like, this is exactly how you should not describe your team.
So emerging managers, first-time funds, firms, whatever, have a pretty cool opportunity to get it right day one. And by get it right, I mean go out and hire a team of folks that have, I would say, complementary skill sets and backgrounds. I think if you look across the market right now at the kind of established players, I'm going to call it a problem with kind of, diversity, equity, and inclusion kind of within, finance, but also within private equity. And if you look at the partnerships at, a lot of the firms out there in the market, everyone looks the same. Everyone has the same profile. You've got the same, one or two business schools that everyone attended. Everyone maybe grew up in the same, zip code, if you will. And I think that emerging managers, those who are taking the time to hire and build a, kind of a future-proof team. And I do think that diversity is a big part of that. That is where I get very impressed, because it's easy to go out and hire your friends and hire the people that look like you. It's not as easy to pull together a diverse, kind of an experienced team to go out and invest. And so that to me is when I am the most impressed. And, when it's a team of folks that's clearly, it's very clear that it was intentionally built to be, diverse.
So does that mean diverse at like the second tier of maybe like a principal level? Because maybe I worked with this person at the previous firm and I didn't screen them by diversity.
Mm-hmm.
Like, how do they do that so it's authentic and it's not a forced way?
Right.
Like,
Well, that's why it has to happen day one, right? It has to happen within all the levels of the organization. Like, you hope to see it, kind of within the partnership, but if you don't see it in the partnership, you want to see it in that principal, VP, associate level. You just want to see like a balanced group of people.
yeah. Okay, so first 30-minute meeting is done.
Mm-hmm.
What's next in an amazing process for you?
Next up in an amazing process for me is a combination of looking at a co-investment that they have, in process, right? So the next part is probably a combination of looking at a live deal. And I just say that because there's a lot of noise in the market. There's a lot of pulls on everyone's time. And there's no better way to get an LP engaged than to show them a deal. Just that's, you need a deal to really engage in conversation, to have them want to do more work on you. And so it ends up being kind of a parallel path of looking at a deal, but also doing that track record work. And so after that first 30-minute call, as we're engaging with a manager, we typically will say, all right, let's either go through, if it's an independent sponsor or, a first-time fund, let's go through your track record. And it could take anywhere from, 45 minutes to upwards of 6 hours. I think 6 hours is the maximum that I've spent recently, not in one call, but like it's been, we kind of tranched it over time. And just going through the track record, sourcing the story, the value creation, the exit, what role did this partner play? Who else was involved? Those kind of things. I'm just having a good understanding of the track record. So that's one. But if it's maybe for a fund two opportunity, it's walking through that existing portfolio that might be unrealized.
Yeah.
And looking and hearing the story about that, but then saying, well, gosh, okay, you've marked it up to 2 times invested capital. It looks like revenue's grown at 10%, but earnings have been flat. Like, tell me about that. Like, why have you marked up your business when you're not growing earnings? Like, what's going on kind of within the numbers, and understanding what's going on there.
How much on the track record for not fund two, but like fund one, what are some of the key questions that you have to ask that probably should have been conveyed in a deck or an email overview? Like, what are some things just to make the process more efficient?
In January of 2010, we invested $70 million in this company. Like, literally, like just the basic like numbers of what it was. And a lot of groups a lot of times you'll see like kind of a nice, schedule of investments, if you will. But a lot of times you don't get that. And sometimes getting that is a little bit like pulling teeth. And so having a schedule of investments, and look, in today's day of Zoom, you may not be able to, email me a file, but a lot of times you can show me something on the screen that's sort of an example and we can talk through it. Or if we're in a room together, you can show me something on a sheet of paper that says, all right, like these are the deals that I've worked on before. This is what the schedule of investments looks like. Of like invested capital, how much you realize, basic things like IRR and multiple, and things like just the basic quantitative info, which then allows time to talk about the more interesting qualitative stuff around value creation and, kind of what you did and who you brought in. Did you change out management? Did you not? Did you do add-ons? Was it a buy and build strategy? What did it look like?
So first meeting's done. Now we're talking, let's focus on fund two in the process. Mm-hmm. How do they manage the momentum in a beautiful process? Like, what does it look like from your perspective at first meeting? How many more months? What do you need just to make it an easy process from your perspective?
For fund two. So I would say that over the course of investing your fund one, you need to do what you said you would do, which sounds very basic. But I think that that is one of the fundamental building blocks of a successful private equity manager is when you're raising the fund, say, hey, this is what we want to do. Like, this is what we're going to do. We're going to invest in deals that look like this. When you're deploying the capital, do exactly that, right? Stay within, the parameters of size, of sector, of purchase multiple, maintain stability on your team, grow in the way that you said you would grow. If you said you'd hire more operating partners, hire more operating partners, retain your people, and, make sure that your investments perform. And if they don't perform, I would say it's probably better to just come clean and tell your LPs of like, hey, this didn't go well. This did not go the way that we thought that it would. Here are the reasons why. Here's what happened. Here are the lessons that we're taking away from it. This may be a loss, that it may not. But I would say just being open and transparent and being a real partner with your investors is very important just over the course of investing your fund one. And then when you're coming back for fund two, an exit is always really helpful. It's not always convenient. It doesn't always happen. But if you're able to, over the course of that fund one, do what you said you would do and also have an exit, then raising that fund two shouldn't be a problem, even in a market like this.
What kind of updates do you think are valuable to get throughout the process? Like, what are the updates you're getting? Like, all right, I don't really need to hear about that versus ones like, all right, that's substantive. I need to hear about that throughout your fundraising process.
The fundraise, I think the things that I want to know about, like, so if I've committed to a fund or if I haven't committed.
Let's do having committed to a fund. And maybe it's a fund one, you're like, you know what? Maybe
Mm-hmm.
I want to hear updates like this. And also maybe for fund two and throughout that.
So I want to hit the substantial updates are around, closes. So, you've got 500, you're targeting 500 million and you just had a first close on 100. Like, I'd like to hear about that, right? I'd like to congratulate you. I'd love to hear kind of how it went. I'd love to hear kind of the profile of the LPs that came into that close. Like, you don't have to give me names, but, just because I'm more curious of like, was it, European insurance companies? Was it, sovereigns? Like, who knows, right? So closing as well as kind of investment activity, right? So if you have had your first close and you've now done your first deal, like those to me are two very, kind of nice milestones. I would say new hires, less so unless it's kind of at that partner level, right? Like if you've had an associate start, like that's awesome, but you don't have to ping me to tell me about it. Like we'll go through that and we'll kind of the updates on the team, in the next call.
So maybe let's rewind a little bit. I want to go into like the fundraising deck because I think it's so critical to just getting to that next stage of what is the substance, maybe even the order of the slides. What do you wish, like, God, why is that in the back? Put it up at the front.
Mm-hmm.
Like, what's kind of like the order of the slides that you like to keep it? I know this is getting nitty gritty, but I'd love to kind of
Yeah.
hear what do you like to hear up front? What makes your life easier?
So I'll say that I tell people on my team this all the time. I tend to think that the page number that the performance is on is sort of inversely proportional to how good the performance is, right? If you've buried it all the way at the back, then it's probably not that great. I say always lead with an executive summary that kind of summarizes the takeaways of the deck on one slide that says, we are, this is who we are. The team has worked together for how long, and here's what our strategy is, and we've demonstrated performance, and here's kind of maybe big picture how we've performed. So I think an executive summary is important. I think the team leading with the team is helpful. So I think typically you see kind of team strategy performance, and within that strategy, it's typically like why us, why now, and I think that that's important to do too. And then it typically goes to kind of case studies. And I would say in case studies, there's a lot of hesitation around including a situation where things, haven't maybe gone so well and where there's been some lessons learned. I would say, I don't know, I like seeing balance in case studies and I like hearing balance in terms of kind of a GP and their experience. And I'm not going to penalize somebody if they have, lost money on a deal if they can explain to me why it happened and what type of steps they've taken to ensure that it hopefully won't happen again. And look, because then there's a lot of things you just can't anticipate.
And I think that highlights your earlier point of like, this is a partnership. And in a
Right.
partnership, can't just talk about all the good things. You got to talk, hey, here's some bad things, but how we work through it. And maybe things that we did wrong that we learned from as a manager and are, whether it's changing the value creation plan or whatever it is, or they need to have a key hire who had operating expertise, but walking through the logic of the good and the not so good.
Right. I mean, some of the better co-investments that we've had, the strategy, the value creation strategy has looked a whole lot different in execution than it did when we underwrote it, right? You can underwrite something and say, you know what, I think that we can, really grow this whole thing organically. And then something happens in the market or something happens within the industry. And it's like, well, no, actually not. We probably need to scale and we need to diversify our product set or kind of whatever that is. And so this is going to be now more of a buy and build. And so I have a lot of respect for groups who can say like, look, we thought it was going to be this and we had to pivot and do something different.
Maybe I kind of take a big step back and summarize what I want to also talk about funds. I know you don't do as many commitments, but you've seen a ton of fund ones. Like
Mm-hmm.
the ones who have successfully raised that first fund, like what are some of the common themes that you've seen, and particularly in this market of how people can get that first fund raised?
Sure. So I think that the successful fund ones come together quickly when you have good investors who were investing at a partner level at their prior organization. At least two people, right, coming together that have attribution that's easy to figure out from their prior institution, right? Like maybe it's not on paper, but maybe it's just something that is it's easy for investors to kind of figure out. And maybe it's because there's press releases on the other GP's website with people listed, like, but there's a way to kind of figure out track record fairly quickly and figure out who to call and how to get there. I think that the kind of the institution where they're coming from matters. It has to be a well respected kind of GP in the market. And I think you've got to have at least, I think what I said, at least two people that are kind of executing on the strategy with kind of plans to build a broader firm. And I think that the story has to make sense, to be honest. So, I mean, there are groups out there that'll raise a first time fund without, kind of doing anything as an independent sponsor, without, kind of, getting co-investments done with, kind of folks to entice them and bring them into the fund. I think that, there's a lot of placement agents out there that are, giving really good advice. Maybe there's placement agents that aren't giving as good of advice, but I think there's groups out there that have been successful that have done it. And those are sort of the attributes I can think of in common of just, experienced investors, good investors from a strong kind of institutional background.
What do you think is the difference between you today as a investor versus you 5, 10+ years ago?
Me?
Yeah.
That's a good question. I would say 10 years ago, I was, I wasn't at Barings, I was in a different role. And I was constantly looking for and having to find reasons to say no. And me today, I'm constantly trying to figure out a way to be able to say yes, right? Like, so it's, I'm not going to say, no outright. I like to, particularly in this market, working with emerging managers, like the reality is I'm going to say no far more often than I say yes, right? We have a 4% hit rate in terms of deals that come in and deals that actually close. So I'm saying no a lot, but what I'm trying to do is say, well, no, not now, but here's what we want to see. Here's what we would need to see to be able to get to a yes. Here's what we need to see to be able to do some more work here. And that to me is, it allows us to continue to develop relationships with sort of everyone that's out in the market. And I also feel like it's a helpful way to give feedback to folks, say, hey, look, like you're not quite there as a team yet. We need to see someone else at that partner level. We need to see a strong bench at the mid level. And we need to see that, kind of solidify over the next couple of years and then come back, right? And keep up with us along the way, but come back after you've sort of, built out your organization a little bit more and, let's talk.
What's kind of your big why for doing this?
My big why? I
Yeah.
like it. I like people. Look, I think that this business specifically is a really nice marriage of kind of fundamental quantitative analysis, right? Like you can't do this job if you don't like following what's going on in the market and you don't like really understanding businesses and what makes them tick. But I think that the qualitative people aspect of it is also very, very important, right? Because you're at the end of the day, you're investing in teams, you're investing in people. And if you're investing in a fund, you're investing in the people that then invest in the people. And so it's a difficult decision, but I do think that there's a pretty big kind of psychological component to it as well. And the people part of it, I think, is just as important, if not more important than kind of the stuff that's in the spreadsheets.
Well, we have covered a lot of ground in this episode. Is there anything that we have left out that you're like, you know what? I want to double click on that?
No, I think that we've covered all of it, to be totally honest. I think we've actually solved the problems of the world. So our work here is done.
Thanks so much for taking the time to do this. This has been fantastic.